Welcome back, everybody. Today we're diving into one of the most important investing books ever written, The Intelligent Investor, by Benjamin Graham, originally published in 1949 and updated through the years. It's a classic that shaped legends like Warren Buffett, who considers it the best book on investing ever written. So let's dive in and discover the secrets it holds. In the next 10 minutes, you'll uncover the core philosophy of the book, learn about Mr. Market and how to beat him, discover the two types of investors, understand the importance of diversification and margins of safety, see how Graham viewed speculation versus investing, and much more. And here are some notes about the book. Let's jump right in. First up, the core philosophy. Graham teaches that investing is not speculation. An investor carefully analyzes a company, ensures the safety of principal, aims for an adequate return, and keeps emotions out of it. Now, speculators try to profit from price movements alone, buying and selling based on forecasts of what might happen without considering the underlying business. Intelligent investors aim to own great companies at fair prices, holding for the long term and collecting dividends while letting compounding returns grow their wealth. Next, Mr. Market. Graham personifies the stock market as Mr. Market, a manic depressive who offers to buy or sell your shares each day at a fluctuating price. Sometimes he's euphoric and overpays, and other times he's fearful and sells cheap. Your advantage is that you do not have to do anything with Mr. Market. You can choose to ignore him. He doesn't know what he wants. Intelligent investors exploit his mood swings instead of being ruled by them. They evaluate companies independently of Mr. Market's daily antics. When he's pessimistic, they consider whether the market price has reached a level where the shares are trading below their intrinsic value. If so, they buy. When Mr. Market is euphoric, they analyze if the hype is justified or if the market has overestimated the company's prospects. Only then do they decide whether to sell. Now, there are two types of investors. Graham divides investors into two groups: defensive or passive, and enterprising or active. Defensive investors are primarily seeking safety and simplicity. They desire a fully managed portfolio that they don't need to worry about, even if it means slightly lower returns. Enterprising investors, on the other hand, are willing to put in extra time, effort, and study to find undervalued opportunities, but they also follow strict discipline. The key takeaway is to pick the approach that matches your temperament, time, and skill. Don't just follow the trend of what's popular right now. Moving on to diversification and margins of safety. For defensive investors, Graham suggests keeping 25% to 75% of your portfolio in stocks and the rest in high-grade bonds. For enterprising investors, he recommends up to 75% in stocks and 25% in bonds. However, the book focuses primarily on stocks. Graham believed in a diversified portfolio across different industries and sizes, favoring large, stable companies with consistent earnings and dividends. This remains relevant today, though some may prefer modern ETFs or index funds for diversification. Additionally, Graham's timeless wisdom extends to asset allocation. He suggests shifting from stocks to bonds as you near retirement to manage risk and income needs. The idea is to stay balanced and resist market manias, buying when others fear and selling when others are greedy. Graham believed that careful diversification is essential, especially in uncertain economic climates. Okay, so moving on to value investing and intrinsic value. Graham pioneered value investing, buying shares of solid companies when their market price is well below what careful analysis shows they're worth. His approach involves studying financial statements, earnings power, and long-term prospects, not just hot tips or chart patterns. This principle is simple yet powerful, but it requires patience, discipline, and knowledge of fundamental analysis. Let's talk about the dangers of speculation. Now, Graham didn't shy away from acknowledging that speculation isn't inherently evil. If you view it as entertainment and keep it to a small fun money account, it can be enjoyable. However, he cautioned that confusing speculation with investing is the path to losing capital. He pointed out that many people borrow heavily to speculate, believing they can make big returns quickly. This often leads to unwise investments and excessive trading, especially when borrowing money increases potential losses and magnifies risks. The key takeaway is that intelligent investors keep speculation separate from their investment accounts. They don't use borrowed money for risky bets. And they never confuse short-term price movements with a company's long-term health. So next up, emotional discipline. In his book, Graham emphasizes that your worst enemy is likely yourself. He stressed that fear and greed drive the markets, but our emotions shouldn't dictate our investment decisions. Patience and humility are vital. Many investors make poor choices due to impatience, trying to outperform the market or get rich quick. Others fall victim to overconfidence or arrogance, thinking they can beat the market consistently. Graham advises against this, noting that few investors match the performance of the averages. His solution is to ignore the noise, focus on analysis, and have the discipline to follow your process regardless of market conditions. Over time, this approach will likely lead to better results than chasing trends or reacting emotionally to market fluctuations. And now we'll discuss some modern takeaways from the book. Even decades later, Graham's lessons resonate today. First, diversify broadly across different industries and company sizes. While he favored large companies, a modern investor could consider ETFs or index funds for easy diversification. Second, always demand a margin of safety. Buy assets for less than their intrinsic value so that errors or surprises don't wipe you out. Third, view market drops as opportunities rather than disasters. Stay calm during downturns and consider it a chance to buy good businesses at lower prices. Fourth, favor low-cost index funds if you're a defensive investor. They offer instant diversification and typically have lower fees than actively managed funds. Fifth, recognize that careful diversification is crucial, especially during tough economic times. And sixth, understand that investing is a long-term game. Don't get caught up in short-term market fluctuations or try to time your investments. Instead, focus on building a solid portfolio of fundamentally strong companies and regularly rebalance. In conclusion, the intelligent investor equips us with powerful tools to navigate the complexities of the stock market. Its timeless wisdom continues to guide investors today, proving that sound principles and thoughtful analysis remain the cornerstones of successful investing. The book's impact transcends generations, making it a must-read for anyone looking to build wealth in the stock market. Whether you're a seasoned investor or just starting, its insights will serve you well. Alright guys, thank you so much for watching. If you like this video, please give me a thumbs up, subscribe to my channel if you haven't already, and leave a comment below. I love reading your thoughts and comments. Feel free to share it with your friends and family. Thanks again for watching. I'll catch you in the next one.